Hi, I'm Mike Azier and welcome to my February video commentary. I promised you last month I would talk about hedge funds, and I will. And the reason is easy to understand. The hedge fund industry is now huge. There's about 6,000 different hedge funds managing somewhere in excess of $500 billion US. The market for hedge funds has become enormous, with all sorts of mainstream investors that you would not expect now investing in them. Pension plans, endowments, and so on. And the way I explain hedge funds to people is pretty straightforward. They're like mutual funds, very much so. They charge a management fee, typically 1 or 2%. But the big difference between hedge funds and mutual funds can be brought down to one simple thing. Hedge funds are not sold to the public like mutual funds are. Hedge funds are available only to accredited investors, which is an SEC term that basically means wealthy individuals and institutions. But they're not registered with the SEC and not sold to the public, which means hedge fund managers can do all sorts of things mutual fund managers cannot do, like short sell securities, speculate with derivatives, use leverage in their fund. And although the hedge fund might have a defined strategy they supposedly pursue, literally the hedge fund manager is often able to pursue any strategy they'd like, in any market, in any kind of securities, looking for profit. But to sum up the biggest difference of all, besides the management fee, the hedge fund manager shares in profits when the fund is profitable. The most normal split is 80-20. 80% of the profits to the investors, 20% to the hedge fund managers. And to give you a legendary story on Wall Street, back in 1999, George Soros, who runs the Quantum Fund, broke his own Guinness Book of World Records as the highest paid person ever. His personal income, cash, was $1.6 billion back in 1999. And his second in command, Stanley Druckenmiller, who was his chief strategist, $450 million. There was 8 other Soros Fund Management employees that year who made over $10 million. And that's just them splitting up their 20% piece. It's extraordinary. And before you start thinking it's obscene, you need to know one other story. Had you invested in George Soros' Quantum Fund when he started it back in 1969, the minimum investment back then was $100,000. So let's say you put $100,000 in and just left it there, didn't touch it. By the 30th anniversary, year-end, 1998, your $100,000 between net asset value and cash distributions had grown to about exactly $150 million. $100,000 to $150 million. I doubt the investors in the Quantum Fund are the least bit angry about Mr. Soros' compensation. But there's a few trends that I see happening with the hedge fund business that I wanted to talk about. Number one, in recent years, has been this fund of funds concept. It is difficult, I can understand. How do I pick what hedge fund to invest in? There's so many. They pursue so many strategies. How do I know I'll pick the right one? So different entities have popped up, banks, brokerage firms, and so on, offering you the opportunity to invest in a fund of funds, which basically means I take your money and allocate it across a bunch of different hedge funds, which might sound like it makes good sense. You get diversification and so on. But don't think that that entity, the bank, the broker who put together the fund of funds, doesn't have their finger in the pie. They do, for a few more percentage points. And you have to start to ask yourself, and here comes the cynical side of me, between the 1 or 2% management fee, the 20% profit, and now this fund of funds manager sticking their fingers in, if the Standard & Poor's is really up, let's say 10%, how much am I going to have to beat that by the time all the different cuts are taken out to actually end up still ahead of the S&P 500? I mean, I'm thinking I'm going to have a 15 or 17% return to basically stay ahead of the S&P. And the cynic in me has to wonder, is it really likely that 6,000 different hedge funds are going to outperform the S&P by 50 or 70% on any sort of ongoing basis? That's hard to believe. That's one trend. Let me tell you another story about hedge funds too. Most of them today have what's known as a high water mark, which means if I take $1 million from you and in a year grow it to $1.5 million, that's $500,000 of profit. Obviously, I'm going to take my 20% out of that, which is $100,000, which will leave you with $1,400,000. That is the high water mark. I won't be eligible for more performance 20% until I get above that. So what if next year I go down? The fund actually drops to $1 million. Well, obviously, I'm not eligible for a bonus, and who knows when I will be again. It's going to take a couple or a few spectacular years, actually, probably, for me to get above the $1.4 million high water mark. But here's an idea. What if I close this fund? And I give you your money back. But lucky for you, since you like me so much and you like my strategies, I'm opening up a new fund, Mike's fund too. So why don't you just endorse the check back to me and you can invest in my new fund? I'm screwing you. I'm screwing you out of the high water mark. And I've seen this happen a lot in recent years. So that's a troubling thing. And that leads me to another story. I was just offshore recently giving a speech and was told a story about a hedge fund manager who had not been profitable, so not eligible for bonus, but actually told the investors that he wants bonus anyway. And if they don't approve the bonus, he would forcibly redeem them, which means I'll kick you out of my fund. You don't want to give me my bonus? Out you go, which is a pretty amazing tactic. But what are you going to do? That's how it goes. And don't write or call asking who it was. I don't know. When I'm related stories like that in confidence, I don't ask because I'd rather not know. Plausible deniability. But that's another trend that has me worried. I'm not downing hedge funds. There's been spectacular disasters. The biggest of which obviously will be long-term capital management back in the summer of '98. But I don't want to go there. The hedge fund industry has been tremendous. It offers tremendous opportunities for investors to pursue returns in all sorts of markets. And by and large, the hedge fund industry, enormously safe, enormously ethical. Yes, there's always trouble. There's always a bad apple, but you don't throw the whole bushel out. So that's my little ditty on hedge funds. A tremendous tool, but those are some observations of mine. Now, next month, and I don't like to do this because now I'm stuck probably talking about it, but I've given a few speeches recently, and I still feel there's a tremendous risk of deflation in the U.S. economy. I by no means think this economy is on just this rosy recovery. I think it's at best tenuous, nowhere as good as the White House or the media wants you to think it is. And I think we're living in a deflationary world, and the U.S. is at genuine risk. So I'll try to dedicate next month to that. Anyway, I appreciate you tuning in. Hope it wasn't too boring. And next month we'll move to economics. Like this wasn't bad enough. I'll see you then.